Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. I'm Victor McClure.
And I'm Guy Allard.
We hope you have had a good. We finally have the stock market starting to correct a little bit this last week, since it went straight up for 14 months.
Finally reminding people that the market can actually go down.
And it's gone on Friday, it was down pretty hard. It was also down on Thursday. Still, it hasn't erased the gains from January, but it's getting close. But do I think it's the beginning of the bear market or the end of the bull market? No way to know. There's no way. It can go straight up next week.
Victor and I were talking before we got ready to do the podcast, and for a year, no matter how bad the news was, the market would go up. Something would come out, it'd go up. Something terrible would come out, it'd go up. Well, now we're getting good news. More jobs than anticipated. Price to earnings are getting better. Employment's going down. And the market's going down.
I remember one of the talking points the other day, but okay, they're getting that kind of stuff, but what about wages? They're not going up. Well, they just went up too.
They just went up as well.
So wages went up, I think, 2.9% when they didn't expect, I think, from 2.3. And so all of the things are going well, all the news that came out this end of last week, but the market went down. So there's no way to tell. Honestly, it always goes up too much in a bull run and goes down too far in a bear market. It's just the way it is.
Yeah, and you can't really identify any one particular thing. There's lots of dynamic things going on, but a lot of them are couching it on the Fed rates. They're going to raise them. Now they said we're talking about three times this year. Now they're saying that they may do it 4, but with that comes a lot of dynamics, right? We were talking about this earlier as well. All of the retirees or people that are close, they're pretty much forced into the market seeking yield. And it kind of made sense, right? It's going up, it's going up, it's going up. You almost forget about the risk. You're going to go in a long-term CD, which they don't even want to give you a better rate for jumbos anymore. It was a 1.5 or something.
No, like 0.8.
Yeah, unless you go to the cyber banks,
yeah.
You could do a little bit better. But what happens when you can get 3.5%? Some people will be happy with that. And where does that money? They're not forced into the market. Now, this isn't a sell-off and run. This isn't a doomsday. But what I think it is, my opinion, is it's just kind of a normalization. You're getting things back to where they were. Rates needed to come up some. We don't want inflation. All the money shouldn't go into the market, but a portion should. So hopefully, maybe we're normalizing now. What do you think?
I think, honestly, the market's been overvalued for 3 years.
Oh, yeah.
Corrections are healthy. It clears everything out. You need them. It's just like inflation cools off an overheated economy. Those certain things you have to do, or when your economy is doing bad, you have to lower interest rates. All of those kind of things are true. So, but will it happen right now? I don't know. All I know is I'm prepared for either way. That's what you have to be. The key is to be prepared.
Be a self-promoter. Our clients are prepared either way.
That's right. Remember, the retirement plans we do are not based on what the market will or won't make. We do a pure stress test on the portfolio. Now, I looked at this again last week. 2 weeks ago, I looked at it in depth, but I looked at it again. And there's a pretty good retirement tool on Fidelity.com. If you got a Fidelity account, it's pretty decent. The only problem, it's a black box. It says above average returns, below average returns, average returns.
So what's average?
Yeah, what do these numbers mean?
Yeah.
Because I'll give you an example. We talked about this before. This century, since 2000, the market has made 5% a year. If you're a 50% market, 50% bonds, you made about 3.5 maybe. Okay? Well, that's significantly below average. Remember, stocks have averaged 10%, right?
Well,
bonds have averaged 7 because they went back to 1926 on these figures. I could read that in the disclaimers. So what are they doing? So average market would be 10 and 7. So you're looking at, I did my plan on the Fidelity website for below average. It's not nearly as low as it's actually occurred right now.
And we identified in a recent podcast that when the market averaged 10%, or I've heard numbers as high as 12, 5% or so was dividends.
That's right.
And they don't do that anymore.
Dividends on the S&P are about 1.8% now. So even if you got that same 5% capital growth, You're looking at returns on the average of 6.8. So that's why I don't like it. So if they're doing average, you put your retirement numbers in there, and they do an average. That's 10 and 7, because that's what they've averaged long term.
Heck of a nice average.
Below average, what is it? 6 and 4. We didn't make either one of those returns this century.
That's right.
So even with the 20% up, you remember before last year, for the 17 years, it averaged 4. It raised it a full point by getting that 20% last year. But you can't take an average, because I have no idea what if the market's below average the whole time. What if it's significantly below average? You have to plan for nothing.
And average, if we've identified also, is not the same number as a compounded number. If you average different years' rates of return and get the average, that's not the same as if you had $1 in there and the compounding effect of that dollar for the same time spent. It's lower when you compound it. You don't get the average.
Right. Remember, when you're averaging math-wise, you'll take 5 years. Let's say it made 12% one year, 15 another, 2, add them all together and divide by 5 years. Sure. That's an average.
Let's say it was made 12 each year. You'd take 5 at 60.
Right. But that's not your actual return. Your actual return is significantly less than that, because your principal is always, if you have down years, because your principal is always less.
That's right.
You're working with less principal on those down years. Therefore, the average is always higher, because if you took the actual return, the last 18 years, it's been 5.27. The average return has been almost 7.
And a real good example of that is you've heard it before. If you lose 50% one year, you have to make 100% just to be at par, just to be back to even. But what would that do to the average? You made 100% this year. It really increases your average.
All right. I saw an article that interested me. I was talking about home inspections. And so what I want to do is kind of tell you what a home inspection, but put it in your portfolio kind of world, right? I've sold and bought many, many houses, right? So I feel like I'm somewhat of an expert on buying or selling, or at least I have experience.
Well, you know what to look out for, right?
I'm not going to be caught off guard, right?
Hopefully, that's right.
And so the last house it was a lake house. The lake was low, which is the worst time to ever sell a lake house. And just trust me on this one. I got $150,000 below the lowest of 3 appraisals on this thing, right? But even then, I'm like, okay, I'm basically getting screwed. I know it, blah, 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 but I'm not going down there. My kids have sports on the weekends. I can't go down there anymore. So I accept that. But you're going through the different things, and the realtor says you got to paint this. You got to do this. You got to do this driveway. You got to power wash this. Go ahead and change these things out. You got all those things in your head. You kind of know them. But then the real inspector comes when you get a contract, right? Oh, my gosh. The GFI switches had to be changed in all of they changed the code since I bought the house or built the house. Little things like that, there's no way you can know, because I don't know the building codes of today or different windows. Well, it was $20-something thousand on a house that was 8 years old, 10 years old. And if you have an older house, it's even worse. But there's little things like that you don't know, right? And that's why our retirement stress test is also a retirement inspection.
And in that transaction, picture yourself not as the seller, but as the buyer. That inspector is your advocate. Like Victor said, you've probably bought many homes in your life, so you know what to look for. If a gutter's hanging off, well, you know that needs to be repaired. If there's a hole in the roof, you know that. But, they crawl through the attic and go underneath, and they give you a list of things that you need to get a good house in working order.
Well, you look at like the average, say 10 years ago. Let's say you're working off 10-year-old numbers in your head, right? Average inflation has been X.
I do that a lot sometimes.
But average inflation is way less than that now.
Yeah.
Let's say you're planning on cost of living adjustments on your Social Security. It's way lower. They changed the formula 2 or 3 years ago. They took off energy, which is the main component of inflation, took that off because, we don't want to pay them anymore, basically. They said because we didn't think it really jived.
Don't they do that with the CPI too and all of that to control inflation? I know.
But there's all kinds there's a vent pipe coming from your radiator that's supposed to be 3 inches and it's really 4 inches now.
Or from your hot water heater, absolutely.
Always things like that you don't know. And that's why I think it's so important.
Which can be hazardous.
That's right. The inspection, I think if you had an inspection before and you had we can tell you if you're within 5 years of retirement or even retired, have it inspected to make sure it's in working order. Because I'm telling you, just by my example of that Fidelity website that's telling you average, below average, above average, that has no reality to today. What it does, it makes you feel better.
Yep.
But that doesn't mean you're prepared for retirement, because the customers that saw that felt they were fully prepared. We redid the penalty, they were still fine. But it opened their eyes to so many things.
And I'll just give you a real brief case study. I've got a client that I've had for a while, great guy. He brought his boss into me, and I've been going through the numbers. We're going to get together next week. He had X amount of dollars, and he was going to get X amount per year for income. He has a lot of pensions, and he said, so-and-so said you did a good job for him. Go through here and tell me what you think. So we were able to go through, Victor and I worked on it together as we do on a lot of things, and we could either get him about 30% more in income for the same money.
I think it's 32%.
Yeah, 32. Or we could get him the same income plus carve out 6 figures for him that he could place elsewhere or do other things or have liquidity. And it's not that the group he was with aren't good people and had the right idea and the right intentions for him, but there's things that they just don't know, and they may not be an expert in providing income. There's several buckets as you go through these inspections. You need your liquidity, you need your income, and then you need some sort of inflation hedge. And you really need to be well versed on all of those so that they dovetail together nicely so that they meet your home inspection.
And remember, there's no cost, no obligation. Get it checked out. I promise you it's worth it. I've never had a person come in and didn't say, wow, I didn't think about that. Wow, that's really eye-opening. That really helps me prepare. Like the one that came in last week, they can't run out of money. He's got plenty, never worry about it. But by looking at it a little different way, we can make it 10 times more efficient. So without giving any more risk, actually lowering his risk, we can get his returns at a certain spot just by reallocating a small portion. But call us at 972-715-2424. We'll be more than happy to give you a retirement inspection. 972-715-2424. Or you can always go to our website, ilovemyretirement.com.
Now, I know I'm going way out on a limb here, but I'm assuming this week with the market's actions is probably a lot easier for you to think, maybe I should take some money off the table and get that income taken care of. A week ago, it wasn't so interesting. It's becoming more interesting, isn't it?
Right. Everybody, I mean, when the market's going well, everybody, even though it's the most logical person in the world.
You feel foolish not to be in it.
That's right. Like, well, I love your plan. It makes all the sense in the world, but I'm going to wait 6 months because I think it's going up for 6 months. Now, they might have heard that on a radio thing or television. The problem is our brains are naturally wired to listen to things that we agree with and disregard things we don't. It's just, that's the way it is. So you could hear one thing and say, this is going up for 5 more years. And if you agree with that, that's when they could have 10 things that's going straight down. You don't even listen.
And that one thing gets multiplied. What do they usually tell you? Well, they say. Well, who is they? They say the market should go up 10% this year, being 2018. Well, who is they? Were they a stock advocate? Were they a insurance guy? And it's just one person. It's not they. It's not a bunch. Right. They say that you should do this.
But you always got to look at it. You got to take the emotional aspect and just have somebody, like I said, an inspector is not biased, right? He's just looking for code violations, obviously water leaks, roof damage. But that's the kind of stuff you need to have.
That's right.
Because I've had people that said, no, I'm pretty sure I'm fine. And then you find out they did a online retirement planning thing or whatever. But I go, you got to dig deep. What are those assumptions based on?
Absolutely.
Because if your below average market is still better than what we've actually received the last 20, that's not a real test. You need to look under the hood a little bit more. And like I said, we offer that no cost, no obligation. Plus, we'll throw in a Social Security optimizing program that could save you several $100,000 or get you several $100,000 more over your lifetime in Social Security.
And not to beat a dead horse, but you got to, along the line of, you've got to know what numbers they use. You know, you would think the bigger section of time that they take, the more accurate the numbers would be, the average or the compounded rate. Well, it's not true anymore. I mean, obviously you want a nice, fair sampling, but things have changed after the Carter years and the inflation and the runaway interest rates.
Today.
Now it's completely different. They're controlled. Right. If the market goes down 10%, they close for an hour. If it goes down another 10%, they close for the day. the rates, the Fed's involved. They won't allow interest rates to go that high again. You wouldn't think.
The one thing I saw in it, it makes it look so good. We're now running 250 simulators. You know, the like little hourglass you get on your thing?
Yeah.
It says we are now running 250 different simulations for your retirement. It's all based on those numbers.
Yes, that's right.
But so you think, oh, I've really got this handled. Remember, call us, no cost, no obligation, and I promise you it's worth it. 972-715-2424. Again, 972-715-2424, or you can always go to ilovemyretirement.com.
And usually what we do, just to kind of give you an idea on this side of the desk, we'll just give you a bunch of options. You know, you can do A, B, or C, and here's what the results will be. And take those with you and sleep on them.
Yeah. All right. Then we're going to finish up what we talked about last week. Remember, for years I've been talking about on the radio that on KRLD, on the podcast, all that stuff, that right now bonds, there's a lot of risk. As soon as the Fed funds rate hit zero, 4 or 5 years ago, bonds are not paying, they're not paying you for the risk you're taking. Because remember, interest rates go up, bonds go down. So if I've got a 10-year bond paying 3%, basically, and interest rates are zero, the best I can make is 3. Because if they go any above that, I could lose part of that 3, even part of my principal.
That's right.
So for right now, when the market's peaking and interest rates are the lowest, that's when you have the most issues. Okay, you got to really be careful with the bond portfolio. And what has more risk? Anything that's paying, say, 4 or 5%. I had a customer goes, no, I got this Vanguard bond fund. It's fantastic. It doesn't have any risk, and it's paying like 4.86 yield. I go, okay, but they're going rates 3. Now, I understand these are very good. These Vanguard managers are very good. I go, they've got high yield bonds in them.
Yeah, corporate.
They've got long bonds in them. What happens is the longer bond, longer means the term. So if you got a 20-year bond, much more risk than a 1-year bond.
It's affected more.
That's right, because a 1-year bond, they know it's going to go back to $1,000 in a year.
Meaning
so they're not going to drop the price much.
Right. You hold it to maturity, you're going to get your $1,000.
Right. With a 20-year bond, they're like, oh my gosh, that's a lot of risk. I'm only going to pay $800 for that 1,000 bond. So it dropped 20%. And the higher, the lower rating, which all high yield they used to be called junk bonds. They figured out in marketing 101, don't call something junk and try to sell it.
High yield's better?
Yeah, the high yield sounds great. But that is it. All it means is you're below a triple B bond. And if you look at the default rates on bonds, it's about 0.1% on so 99% of the time it doesn't default on an investment grade. It defaults 15% or so if you go just one step down.
Yeah.
And looking for yield, all these last few years, all of these bond funds have had to get a lot of high yield in there. Otherwise, nobody wants to buy a bond fund that's been averaging 1.5%, right? So they had to put the long ones in there, the long maturities,
right.
And they had to put the high yield or junk bonds in there.
To make it attractive, to sell it.
Those have extremely a lot of risk right now. And I've been saying that you could use an index annuity, not for the income side, but just the growth side, and put that in there. It has no market risk, no interest rate risk. And you've got them paying, right now I've got some pay 5 to 7% is the worst they've ever done over rolling 10, 12-year periods, 5. The best they've ever done is 7. Well, 5 to 7 versus a 3 that if interest rates go up, I lose the 3 in possible principal.
And what do we know? We know that the Fed's talked about increasing the rate 3 times this year. Now you hear rumors of maybe 4. So as those rates go up, remember the inverse relationship. And why is that? Just plain and simple. If you have a 2% bond, although it's liquid, before you don't have to hold it to term, and the new ones are 2.5%, I'm going to take my $1,000. I can either buy a new one at 2.5%, or you're going to have to discount your lower rate bond to attract me to buy it. That's why they go down in value. And again, for emphasis, what do we know is going to happen this year? They've already talked about they're going to raise the rates.
Now, does this mean it's going to be 6%? No. You're talking maybe quarter point, eighth of a point raises, to get up
right.
1 or 2% over the next couple of years.
But if you're going to sell your bonds early, it will affect you.
Oh, absolutely. Just make sure. So I've been talking about this for years. Now we talked about last week, Roger Ibbotson. He's famous for the Ibbotson charts. All the charts you've seen of brokerage firms, they don't do it as much anymore.
No.
They're more. Every brokerage
everywhere.
firm I ever been had this Ibbotson chart. Showed you, okay, you got $1. If you put it in bonds, government bonds is worth $40 in the last 100 years. Then you go corporate bonds worth to $500. Then it says stocks, $5,500 just for $1, right?
Yeah,
55,000% or whatever.
Yep.
So it's always showing you, hey, long-term stocks are the thing. Well, Roger Ibbotson also recognized, like I did, that, hey, bonds aren't rewarding you, and they have a lot of risk for what you're taking here. What could we do else? Let's keep our mind open to something else. He plugged in the same thing I did, an index annuity. Index annuity, folks, is not a variable annuity. You can get these for no fees, no commission, no loads. They pay the broker, but you don't have to pay it. So you got all of those, and you get them for pure return. It's just a pure bond play. And he put those in there, and it's pretty interesting. What he found is the returns went up on almost every scenario, and his risk went considerably down just by he replaced part with a bond of his bonds with a index annuity, and then he replaced all of it. In other words, you have a 60-40 portfolio.
And it actually shows you the numbers.
Yeah.
Now, go ahead.
Every single time you added the index annuity, it increased your return and lowered your risk.
Now, just to confuse you completely, in his report, we were talking about you got to know what the black box is, what numbers. He's using a 60% participation, meaning you get 60% of the market. You don't take any down years. Right now, because rates have gone up and your money's basically in bonds in these, they've increased the rates. One of the companies, big company that you guys are all familiar with, has increased it. You can participate. You can get 95% of what the stock market does. They credit it every 3 years, but you don't take any down years. 95% of the market with no down years. Are you kidding me?
What we've got is it gave you different things because he assumed also the interest rates are going to raise. They're not going to stay at zero forever.
That's right.
So he said, all right, well, we've already determined. Now, Roger Ibbotson is, by the way, a Yale professor. The Ibbotson charts is, everybody knows who that is. It's like I said, this is not somebody selling annuities.
You're dating yourself. You know, he was real hot in the 80s and the early 90s, right?
This is the thing about it is every time you'll see a stock guy, he loves stocks, hates annuities. Annuity guy loves annuities, hates stocks. This guy has nothing to do with it. It's a Yale professor just doing a study.
But he is a stock guy by nature.
Absolutely. Remember, he's the one that said stocks are the thing. Look at the chart.
Yep.
Right? But he's saying, hey, you plug this into the bond side, it really works. But now he knows interest rates are probably going to go up. What happens if we increase interest rates, say 1% over a 3-year period? That's pretty modest, right? So if you're if you're a 60-40 bond portfolio, 60% stocks, 40% bonds.
Yep.
If the market's making, say, a 10% over 3 years, you get 5.8. That would be your return. But if you replace the bonds with index annuity, you get 7.5. You don't think that's a lot, but that's a 20% return, and you've eliminated your market risk on half your money. Okay? Now, let's say it does it over a 2% over a 3-year period. And that's not much. If they do 4 things this year, it might rise at 1 or 2 points this year. But think about it. So it's only going up 2% over a 3-year period. The 60-40 stock and bond portfolio, if the same, you average 10% or whatever, you made 5% on the 60-40 portfolio, 7.5% on the 60-40 index annuity portfolio. So basically, 50% increase with lower risk.
That's right.
Now, I don't know if this is going to happen. I'm just telling you what it's showing. 3% increase over 3 years would be 1% a year. I think that's a little high side. But if it goes 3% over a 3-year period, your 60-40 portfolio would make 4.1%. Remember, your bond piece is losing money.
Right.
You're making 10% of your stock piece, but the average overall, you made 4.1. With the 60-40 stocks and index annuity, 7.5% again. So remember, because you didn't have that interest rate risk. So you're just getting pure return. So if it goes up 2% over 3 years, it's a 50% better. 3%, it's 60-something% better. And it's about 20-30% better even if it goes up just 1% over a 3-year period.
Well, and the interesting deal was, too, if the market did nothing for a particular year, your 60-40 bonds or we'll go 60-40 bonds versus 60-40 stocks and the index annuity. Your 60-40 bonds actually would lose money for the year.
That's right.
If the market was a 0 year. Obviously, if the market loses, you're really going to lose. But if you were not in bonds and you were in a fixed annuity, you'd be at 0. You wouldn't gain anything, but you wouldn't have had the loss.
Let me go we're getting closer to the end of the show. I just want to remember, all we're doing is replacing an index annuity with a bond. Because bonds right now, the best you're going to make is 3 or 4% on a bond, and you have all that interest rate risk and things. So, and like I said, Roger Ibbotson is no annuity hawk. He's just looking at alternatives. I'll read the conclusions. We began with conventional wisdom. This is the conclusion of this report. And we'll send you this report. Just call us. We can email it to you, send it to you a hard copy. Number's 972-715-2424. Again, 972-714-2424. It says, we began with conventional wisdom. Stocks beat bonds by a wide margin. Stocks are riskier than bonds. As we approach retirement, is it prudent to de-risk our portfolios and shift a greater allocation toward bond-like investments? Although we believe this wisdom is still true. In other words, as you get older, you get more safe, right? We caution individuals preparing for retirement not to become complacent, particularly in this low interest rate environment. Each person's goals and risk tolerances are different, and there are other options to consider. It says annuities have for a long time deserved a place in retirement portfolios, and the evolution of the industry has made these vehicles more flexible and more attractive. That's the main thing I want to say. The annuities of today are nothing like the annuities 20 years ago. The index annuity, when they first came out, because the major wirehouses didn't do them, your Merrill Lynch's, your Fidelities, all these different ones didn't do them, they all said, oh, we don't think they're good. Every major wirehouse does them now.
That's right.
Every major one. They have become they're not loaded. Your fees are 1% or less. It's different. I think a lot of it's baby boomers coming to retirement. We are more educated. We had the internet. We know more. We're not going to pay ridiculous fees, even though I see it every day. Somebody buying something with 5% fees. I don't get it. But it says, as with any investment, working with a trusted advisor and doing your own due diligence is key. It says, fixed index annuities have many attractive features as both accumulation investment and a potential source of income in retirement. In simulation, the FIA performed better net of assumed fees than long-term government bonds. We showed the FIA comparable volatility to bonds, but with better downside protection. In our study, when bonds underperform, the FIA performed quite well. In our view, considering low interest rate environment and the modest expectation for bonds returns in the coming future, FIAs are the alternative to consider. I've been talking about this for years on the radio show, but it really takes an academic, a Yale professor, to do it for people to believe it. People believe it, but it's just not as much.
The problem, and we've talked about it before, Roger here isn't spending $1 million a month advertising this on all the TV channels. And when that happens, it becomes fact. Very few people know about this.
Right. And so, remember, somebody told me, well, Ken Fisher hates annuities, and you should too, or something like that. I go, yeah. For every one you give me like that, I'll give you a Nobel Prize winner or an Ivy League professor that says they don't know what to tell me. They're just trying to say something else. But you just got to leave your mind open. There's nothing wrong with bonds. There's nothing wrong with stocks. There's nothing wrong with CDs, and there's nothing wrong with annuities. Variable annuities, I think that there's benefits, but the fees are too much.
You got to be very selective
right,
which ones you
very
do.
selective on variable annuities. But everything has benefits, everything has its place. Now they're finally putting this stuff in academic studies that show, okay, what if we use this alternative instead of a bond just because of the circumstances we're in now? Once that Fed funds rate got to zero and bond yields lowered to a certain point, they now became an asset class that I need to find a better fit for.
And the bonds can't get back quick enough without causing issues to change the situation.
Think about what we just said. If it raised 2% over 3 years, which is not much, they're not raising a lot, 2% over 3 years, the bond index annuity portfolio got a 50% better return.
The
5-0.
stock annuity portfolio.
If you had 60-40 stocks versus bonds, or 60-40, the 40% is either in bonds or it's in index annuities.
Correct.
That's a 50% increase in your return, and it lowered your risk. And that is really important. Don't hesitate to call us. If you have any questions, we can send you an information kit on some index annuities that fit this, no cap ones. And also, we'll send you this report from Roger Ibbotson. Our number is 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. I'm Victor McClure. For Guy Allard, we always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment, product, or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.